Hey guys, welcome back to the show. This is Capital Mindset. So today we're going to be doing another subscriber request. This one is an international company. So again, we're going to be going over some of the tidbits about what to analyze an international company. Now, this one was quite interesting, I got to say. I've known about this company for a little bit, but it's an interesting pick. So it goes to show that people out there, they're really looking abroad, or maybe this person who requested this is from the Eurozone and they are familiar with the products. But, you know, I just gave it away. It's from Europe. And the company right now is called JD Peets, right? And I say right now, not because they're changing the name, just because I said right now. So essentially, we'll start, as always, with the price, right? The price action's been quite interesting. Now, I'll show you on a different website the price action in a better light, because Google, for some reason, is not scaling this properly. So it has these two dips right here. But essentially, it has the prices correct. It's not that they're wrong. So $44 was its IPO. So it's actually really down since the IPO. So now it's an interesting proposition. And it's been about a year now, or sorry, over a year since the IPO. So now us as investors, we can come in and see, is this worth an investment? Now, they're known a lot for their coffee shops, right? And their other brands, and we'll discuss those brands very shortly. But think of this as kind of a potential long-term down the road. What is their maximum capacity, right? And I think that could be, you know, you could make the argument that Starbucks is a long-term example of something of the potential, right? Not saying that they will achieve that, but it's something that they can strive for. So let's take a real quick look at the brands, right? And you guys can kind of tell me if you guys are familiar with some of these. Some of these I am familiar with. So I'm familiar with Pilau, and then Super as well, Peets Coffee as well. But some of these I'm not familiar with, but they may be for your local area, etc. So I'll actually quickly show you guys a different chart, or a different example of that chart. And here it is. So this is the same IPO price and where it is today. So you guys could visualize it a little bit better than what Google was providing us. So now let's actually take a look at the, or a lesson reminder as to how to calculate the free cash flow for IFRS. And we can do that by going here. So real quick, I won't spend too much time here because I have other videos on that. But we get the net cash provided by operating activities, and then we subtract out purchase of property, plant, equipment, purchase of intangibles, and lease payments. So if lease payments aren't directly listed there, that's unfortunate. But you're supposed to also take out lease payments if they are there, because that's cash from the operations, right? And then you also have included in there the purchase of property, plant, equipment, which is CapEx, and purchase of intangibles. You could think of that as investments in branding or something like that, but it's intangible assets or software as well. All right, so now let's take a look at the presentation. And again, this is the sales pitch of the business, right? So we want to make sure that this intrigues us. If it doesn't intrigue us, there's not really going to be much else usually. So again, this is like the highlight reel of JD Peets. Okay, so let's take a look at that. So they are advertising below 3 times leverage, means they have a really good investment grade. They have positive sales growth. So organic sales growth is the key word here. So for those of you who may not know, organic sales growth simply means that they grew the same store sales, right? Because you can grow by opening new stores, but then you want to measure, are existing stores doing better? And that's important, okay? So remember that they're not just coffee shops. They're also these other distinguishable brands that they can sell in a variety of ways, okay? This is very important to note, strong cost pressure. Okay, so they are going to always be tied to the commodity pricing of coffee. Okay, so coffee is actually quite important. And one of the largest coffee producers, I think, is Nestle. And you want to make sure that JD Peets is able to navigate this environment well. Otherwise, things can get bad pretty quick, right? And then as well as you can think of inflationary pressures and other avenues of their business. You want to make sure that they're able to manage those properly. I don't think there's anything indicative that they're failing at that, but it's just something to think about. Those are the risks to think about long-term. All right, again, organic sales growth, highlighting that. The in-home, the away from home categories, Great. I like to see that slight decline in away from home. That makes sense, kind of, because of, you know, how the world was for a little bit. Taking a look down here. Okay, so we got different types of products, geographies, categories, and channels. We want to see growth across the board. E-commerce, very interesting. So they're selling the brands. This part is growing. I like to see that. Taking a look over here, US, Asia, rest of the world. That's what RAW means, rest of world. So taking a look there, organic sales growth. And that's interesting, but that makes sense, right? So between first half of 2020, second half of 2020, they had declines, lockdowns, and then in 2021, back to growth. Asia, same thing. So the story is basically there. United States will be a large market, as it is for most businesses in the world. So we want to make sure that they're improving. Asia is an interesting market. So there we are. All right. So discounted businesses. So this is basically the different categories that they have here. So portfolio developments, they have, sorry, discontinued. I said discounted, discontinued. So these are gone. They're no longer part of the brand portfolio. These are new partnerships. So everyone may be familiar with James Smucker. And then this is merger and acquisition. So they bought this and now they're adding it on. And bolt-on acquisition is management's lingo of saying, you know, they buy something and they bolt it onto the company. And now it's just part of the company. And I think everyone knows also Pret. Pret's actually pretty, I've been to them in New York and they're pretty good, to be honest. But here we go, some products. Okay, so won't spend too much time here. That's something anyone can look on their own. Okay, so here's kind of like their cost production inflation. Remember I said you want to pay attention to that. Here they are highlighting that. It's good to note that they're paying attention. And I think from here, we're just going to go to the model, but again, highlighting again, organic sales growth. You can see why that's important. Okay. They're really trying to highlight that to you. Profitability. Okay, cool. Profitability. Ooh, I don't like that number. I don't like when they do that, but that's fine. They have free cash flow right here. So free cash flow, that's cool. And remember, this is the half year. So if you had done the calculation, as I stated, you would have gotten very close to this, but here you can use this number and then you can estimate and say multiply it by 2 and you get the full year, but technically you don't want to do that because, you know, you want to account for cyclicality within the year because one half of the year might be different from the other half of the year. And when I say cyclical, I don't mean like large cyclicality. I mean like, you know, little minor amounts. Okay. Okay, so let's actually jump on over to the model and let's actually take a look at the ratios and we'll start here and then work our way to the actual valuations. So in a current ratio, cash ratio, they look poor or terrible. I would put not too much credence to this because of the type of business that they are. Normally if this were another kind of business, I would pay more attention to that. I'd be a little more concerned. Again, looking at the debt ratios, we want to see improvements. We do see improvements, long-term debt ratio improving. So they're paying down debt. Very good. They're now a public company. Want to see them be responsible with that. Gross profit margins rising. Awesome. Operating margins rising. Awesome. And we want to make sure also that they're rising in comparison to prior pandemic. Very important. Okay. Prior pandemic, 43.34, 43.75 may seem very small, but every little bit counts. Don't discount that from management. They're doing a good job there. Operating margins, operations have become quite a bit more expensive, I guess, but they are coming back to normal. You could say that they're back to 2018 levels, just about. Net profit margin. All right, great. They're getting back to where they were in 2018. 2019, they had a little dip. 2020 was not so good, lockdowns and stuff like that. And then ROA, ROE, okay, decent for what this kind of company is, okay? So if this were another kind of company, that would not be good, but for this kind of company, it's good. All right. So taking a look here, earnings quality, they pass across the board. Awesome. Great. Book value per share, don't really care too much. And I want to highlight that may be subject to change because of it's pulling in from IFRS. So ignore that. All right. So taking a look at the activity ratios, we want to take a look at the cash conversion cycle. Amazing. Whatever they're doing, great. They have the ability to collect that cash, right? They make the sale and get the cash very easily. All right. So that means that they have probably agreements with their suppliers. This probably is like the coffee sellers, for example. So this is good. I like it. I like this company so far. Let's actually go to the summary report. I think I already plugged it in. All right. So in essence, we want to take a look at what growth rate do we think is appropriate, right? And then estimate into the future that probability, right? So let's say, for example, we want to say they can grow at around 10% per year, and you want to discount it and don't assume dilution or buyback. So let's actually remove that because I'm not going to assume it. And there's simply just not enough data on what they will do. So I can't really make an educated guess on that. So unfortunately, I'll have to stop there for that. But this business, if I'm discounting it very heavily, I have to expect above a 15% growth rate. So let's actually replace this with a 17%. So if you can expect 17% growth going forward, if you think that that's possible, then this may make sense. Of course, we're discounting it quite heavily. Let's actually discount it at about 15%. So at a 15% discount rate, we're still actually above market rate of return, according to historical measures. But we're perhaps getting into an interesting business that may actually grow at about 10 to 8%. I think I'm quite comfortable saying that they could grow at 10 to 8%, considering everything that they have the potential to expand into. But we'd have to really see. There's still simply not much is in the form of like what they'll do with dilution, because that will drastically change the numbers. So if, it's for everyone to see, if they dilute you by about 3%, the share count is going up and up and up. And then that's going to kill you slowly or quietly. And then you're not going to understand why you're underperforming. Well, that's simply because the dilution rate. But let's remove the dilution again. And then I think that this is possible. Okay. And then, so in conclusion, this business is interesting, a lot of potential. It's not actually quite that expensive at a price to free cash flow about 14.12. If you think it's just going to continue to grow from here, if it did pull back significantly, this actually would be a business I'd be very interested in. So what I'm going to do is actually start a small position in this company, and kind of watch it. It'll be as small as a speculative position, perhaps a little bit smaller. And then what I'll do is I'll watch it over time. And if it ever reaches a buy price where I think this would be a very good purchase for me, okay, at about $20-ish, then I'd consider this making a not very large, but decent sized investment. Okay. So that's just my 2 cents. If you guys have differing opinions, please feel free to comment down below anything that I missed. And then later down the road, if anything changes, I'll do another analysis on this company, go a little bit deeper on some topics. But basically just now on the price, on what the business does, I'm comfortable with starting a starter position and then watching it to see if there's any new developments that cause the price to come down, make the risk reward a little bit more interesting for me. But I do think it's actually a good company. Okay. This is a good company. Is it a great investment? That has yet to be seen. Okay. But it wouldn't be a terrible one. I'll say that. All right. That's all, guys. If you guys have any other requests, leave them down below. Again, remember the new kind of rule. If it's a micro cap, I'll only really cover it if there's a lesson to be had from it. Otherwise, going forward, I'm going to be avoiding those, or I'm going to tend to avoid those. And again, if you guys have any questions that I covered something and you have another detail that you want covered, comment down below. I'll try to get back to you guys as soon as possible. I do this and work, so you bear with me on that. But thanks, guys. Have a good one. Bye.